Hello and welcome to this edition of Euronews Business Profile. Today we're going to take the mystery out of hedge funds and we're going to clarify some of the misconceptions surrounding these investment funds. Well, joining us now for more on the subject is Dion Friedland, chairman of Magnum Funds. Dion, welcome. Now, I know that you were not always in this business. You started your career in retailing. Tell me a little bit about yourself first.
Well, as a law student at the age of 20, I started my first discount retail store. The company was very successful, grew into large size in South Africa, where I'm from. I sold the company in 1985 and then invested the proceeds in markets around the world in mutual funds and stocks. And unfortunately, in the big crash, October 19, 1987, I lost half my net worth in one day. As a result, starting in 1988, as I got brave enough to start investing again, I only invested in hedge funds on the basis that I felt I wanted to be able to sleep at night.
And could you define a hedge fund for us?
Well, a hedge fund is actually a term that is inappropriately applied to all kinds of investment funds other than pure mutual funds, money market funds and bond funds. So that by definition, therefore, the word hedge fund applies to this huge variety of funds that are as different from each other as animals in the animal kingdom, which would mean that as you have elephants and tigers and rabbits in the zoo, so you have very risky, very volatile hedge funds, and you have very safe, very, very good hedge funds to invest in that are much safer than unit trusts. Conversely, you have some that are much riskier than unit trusts.
Just because the perception out there is that they're extremely risky financial vehicles.
There's an enormous misperception that's been created by the media, because the media only reports on things that are sensationalistic. So that when a global macro hedge fund loses $500 million or makes $500 million overnight, it's headlines. When Tim Smith concludes his 12th successive year of mid-teen returns as a convertible bond arbitrager, it is not news and therefore never reported.
Now, how do you create these stable returns year after year? How do you do that?
Well, these stable returns can be created in particular investment strategies. Now, these different investment strategies allow hedge fund managers to A, produce stable, consistent returns if that is their particular objective and the particular strategy employed. On the other hand, if the objective of a particular fund is extreme growth with high volatility, that gets called a hedge fund, but it's not a true hedge fund in terms of hedging against risk.
But can't unit trusts, mutual funds, do exactly this, what you're suggesting?
Well, mutual funds or unit trusts are legislated, they are controlled, they are limited, they have handcuffs on them, in effect, that prevent them taking measures against market downturns, so that they cannot actually buy adequate insurance to guard against the market downturn, even if the portfolio manager believes that a downturn is imminent.
So you're saying that hedge funds offer you more alternatives than unit trusts, mutual funds?
They do. With hedge fund investing, you can actually choose the type of strategy you invest in. So depending on the kind of strategy you've selected, you can invest in a hedge fund that gives extremely predictable and stable, consistent returns, or you can go for a more aggressive style of hedge fund investing that will be more volatile, that potentially can give you larger returns, that can also result in some losses, as these kind of more aggressive hedge fund styles don't necessarily hedge against all risk. So there is a big difference you can select with hedge funds.
Now let's talk about Magnum funds. How well have they performed?
The Magnum funds during the past 3 months alone have had 5 category winners worldwide in their respective categories. So that we've had the best global equity fund in the world, we've had the best hedge fund of funds in the world, the best fund of funds in the world, the best US equity fund, and the best UK equity fund, all during the past 3 months.
And who is the average investor in hedge funds, if you can describe them as average?
Well, the investors in hedge funds, quite frankly, are the people who are more sophisticated investors, people who've been around, people who understand that their markets actually can and do happen. So you tend to find that it's the older investor who invests in hedge funds, the more cautious investor invests in hedge funds, and also the more aggressive investor will invest because of the variety of styles available to the investor.
One of the things you specialize in is fund of funds. What is that?
A fund of funds is to the hedge fund community almost what a unit trust is to the average investor. A unit trust invests in a wide variety of stocks to give a diversified portfolio investment for the investor. So a fund of funds in the hedge fund industry invest in a wide variety of different hedge fund styles, giving the investor exposure to all of the different categories and styles, and giving him the ability to pick a fund of funds that targets conservative or aggressive returns.
So that is the advantage, that he can almost customize what he wants.
Exactly. Particularly in dealing with our company, he has the ability to focus very closely onto his investment objectives and to select the fund of funds that can deliver performance in line with objectives.
Now tell us about Magnum's funds of funds, how well they've performed and what you offer.
Well, Magnum offers funds starting at the most conservative, a fund that will deliver on a consistent basis returns in the 12 to 18% per annum with extremely low risk, extremely low market exposure. And alternatively, we offer funds in things like pre-emerging markets that are speculative, that offer huge upside potential, but that are speculative and do carry quite a lot of risk.
And what is the minimum investment in your funds?
Well, we've now developed feeder funds into our fund of funds that take investments as small as $10,000.
$10,000, only that?
$10,000.
And when can people expect to cash in the money or to take it out? When do you advise them to do so?
Well, the typical hedge fund investor should have a long-term perspective. So should the typical stock market investor. Nobody should invest in the stock market with a short-term investment horizon in mind. And so it is in the hedge fund industry. The liquidity in a fund of funds is typically once a month. In other words, the investor can invest or take their money out once per month at the end or the beginning of the month.
Now, when it comes to investors, many rely on long-track performance, a good performance over a period of time. But does this really guarantee success when it comes to your type of funds?
The predictability of future returns is dependent upon the volatility of past returns. And with something like a unit trust, all past returns are volatile because they're dependent on the performance of stock markets. As a result, you cannot predict the future direction or performance of a unit trust. In the hedge fund world, however, those hedge funds that employ low volatility strategies and deliver consistent returns are highly predictable.
And how do you go about picking that strategy, the right strategy?
Well, what we do is, of course, we get involved with the various hedge fund managers, and we need to understand where their skill and knowledge comes from. What is their research base? What is their contact level? How do they get those skills? How do we feel comfortable with their ability to deliver consistent returns? We have to understand this. We have to understand the strategy. And once we do, then we either feel comfortable and invest or we don't invest.
Now take us now through how an investor would indeed put money into your funds or any other funds.
Well, we don't like people to invest blindly without understanding what they're getting involved with. So we've developed a website that has an immense amount of knowledge available to anybody who cares to go to it. And on that website, for example, I have articles on the different hedge fund strategies which I've written, which are going to become ultimately a book on hedge fund investing and the different strategies and styles of hedge funds.
So the key thing, first of all, is get an education.
Get an education. We have that information available, an immense amount of it. And I think it's very important because the typical business person spends a lifetime making money and very little time learning how to invest it. And that's a crime.
And finally, how should the investor, when should they get out, if they want to get out of it early, and what do you advise on that front?
Well, many of our funds of funds, for example, are designed as lifetime investment vehicles, very widely diversified investment vehicles, and the investor would have no need to get out of them unless they require some money. On the other hand, with more specific funds that may be country-oriented, there can well be times when the huge upside potential in a particular country is over, and in that case, the investor should move on to another vehicle or another fund.
And how do they keep track of the performance?
Well, we have a website, for example, again, that has all of the fund's performance from day one of every fund on the website. We also list our hedge funds in the various financial publications, such as the Financial Times, European and Asian editions of the Wall Street Journal, and the International Herald Tribune.
Dion Friedland, Chairman of Magnum Funds. Thank you indeed for joining us.
Thank you.
And thank you very much for watching.